Explainer. Today, we're doing a full audit of Bitcoin. We hear it called digital gold all the time, but the source we're looking at today makes a highly provocative argument that Bitcoin is actually the fragile bottom block of a very unstable crypto ecosystem. Let's jump right in. Basically, the argument here is that popular narratives might just be masking some pretty serious structural issues. The source compares it to the bottom block in a massive, incredibly unstable game of Jenga. If an entire industry is built on this foundation, we absolutely need to test these grand claims with hard data, not just the hype. All right, so let's get into it. To properly audit this asset, the source points us way back to the very beginning, Satoshi Nakamoto's original 2008 white paper. The vision laid out there was crystal clear. Bitcoin was meant to be a peer-to-peer electronic cash system. It was designed as this decentralized alternative to banks where everyday people, like you and me, could send payments directly to each other without any middlemen. But we have to ask, did it actually achieve that revolutionary goal? Well, economists generally judge money based on three super basic rules. Is it a medium of exchange, a store of value, and a unit of account? And when you systematically evaluate Bitcoin against these three specific tests, the source argues it completely fails all of them. So let's kick things off with the first test. Rule number 1. Does it actually work as an efficient medium of exchange? In plain terms, can people easily and widely use it as a form of payment in their day-to-day lives? When you look at the data on efficiency, the source highlights a massive disparity. Let's compare it to traditional networks. Visa handles roughly 65,000 transactions every single second. Bitcoin, it's capped at about 500,000 transactions for an entire day. To put that into perspective, this totally illustrates the scale of that bottleneck. Based on the numbers, Bitcoin's entire daily transaction volume could literally be cleared by the Visa network in less than 8 seconds. Think about that for a second. What takes the Bitcoin network 24 hours to process, traditional payment networks can clear before you've even finished tying your shoes. And adding to that inefficiency is a pretty staggering environmental cost. The source notes that just one single Bitcoin transaction leaves a massive carbon footprint, eating up about the same amount of electricity that an average U.S. household uses over 43 days. 43 days! It's pretty easy to see why this hasn't exactly become your go-to payment method for a cup of coffee. All right, so if it struggles as a medium of exchange, we got to move to the second rule and ask, is it a reliable store of value? Does it preserve your purchasing power without massive, unpredictable swings so you can safely hold it today and spend it later? The historical data presented here strongly argues, no, it's really not. A true store of value requires stability, right? But Bitcoin has notoriously swung up or down by 20% in a single month. For a family or a business, that extreme volatility makes it less like a secure savings account and more like a trip to the casino. Now, what's really fascinating here, and maybe a bit surprising, is the concentration of wealth. Despite all the marketing around a decentralized financial revolution for the masses, the data reveals that a staggering 95% of the total supply is actually controlled by just 2% of addresses. And because it's so incredibly top-heavy, the source argues the market becomes highly vulnerable to manipulation by just a few large holders. Take the ongoing Jane Street lawsuit, for instance, which alleges that market manipulation helped trigger the 2022 crypto winter, wiping out $40 billion. That is hardly the secure foundation you want for your life savings. Okay, finally, we look at the third and final test. Does Bitcoin function as a unit of account? Meaning, does it serve as a standard economic measurement for pricing the goods and services we buy so we can actually compare their value? The source says the answer here is also a definitive no. Even businesses that are super enthusiastic about accepting it still price their goods in US dollars. They only convert that dollar amount at the exact moment of checkout. Basically, Bitcoin is merely passing through the transaction temporarily. It isn't acting as true money or an actual standard of economic measurement.
The El Salvador experiment.
Now, a common pushback you'll hear is that Bitcoin just hasn't had a fair shot. But we actually have a real-world experiment to look at. El Salvador's 2021 adoption as legal tender. International remittances were supposed to be the magical use case here, allowing people to send money across borders without all the bank fees. Yet, according to IMF data highlighted by the source, despite heavy government promotion, a mere 2% of remittances actually utilized Bitcoin. 98% of people just stuck with traditional systems.
And domestic adoption, well, that tells a pretty similar story. The government offered $30 of free Bitcoin just to try their national wallet out. But the National Bureau of Economic Research found that 60% of citizens simply downloaded the app, took the $30 incentive, and abandoned it entirely. They basically cashed out and bounced.
When you look at current polling data, the source points out that the consensus is incredibly clear. 66% of El Salvador's population considers the project a failure, and 77% believe absolutely no more public funds should be used to support it. The ultimate real-world field test was, according to this data, a definitive failure.
So this brings us to a really crucial point. If the hard data shows it totally fails as a medium of exchange, a store of value, and a unit of account, why is it worth anything at all? Where does the value actually come from?
Well, the source argues the answer lies in an old economic concept known as the greater fool theory. This theory basically states that an asset's price doesn't actually need to be justified by any intrinsic value, just so long as you can find a greater fool willing to buy it from you later at a higher price.
When you completely strip away the marketing and the online memes, the source claims there are basically zero fundamental economic drivers backing the price. It doesn't generate cash flow like a stock, it doesn't produce physical goods, and it clearly lacks widespread everyday utility. The price relies entirely on the belief that someone else is going to pay more for it tomorrow.
And therefore, the creator concludes this is exactly why we see these constantly shifting narratives. Whether it's pitched as digital gold or an inflation hedge, these stories really serve one primary purpose: to act as a marketing mechanism. They continuously recruit new buyers to keep demand high and keep the price elevated. Which leaves us with one incredibly provocative final question from the source regarding what they call the largest real-time financial experiment in history. If this entire ecosystem is strictly supported by a continuous influx of new buyers, what happens to the whole system when the market eventually runs out of greater fools? Thanks so much for hanging out with us for this explainer. We'll see you next time.